This is important as well to make sure you have it memorized, have this down. What about for the shareholders? So there's no gain or loss if the following criteria have been met. If I'm simply going in and contributing cash, I'm not going to have any gain or loss if 80% controlled by the shareholders who contributed property immediately after the transfer. So we'll see in an example. We could have, and I not to get too much into it because like I said, we will see examples. But if you've got 3 shareholders and they're each getting 30% of the corporation, that's 90% control. So in that group of shareholders, let's call them a group of shareholders, they're getting 90% of control. That's greater than 80%. So that's criteria number 1 here. Shareholders don't recognize gain or loss if they control at least 80% of the corporation's voting power and outstanding shares immediately after the transfer. It could be one person buying 85%. It could be 2 people, each getting 40%. But as long as it matches that 80% or is above 80%, you're good. And then no receipt of boot, property for stock only, as long as you are getting stock only. So if the corporation, if you're giving, let's say, cash to a corporation and the corporation's giving you stock as well as a factory or a truck, that would be considered boot. And as such, that would break this criteria and we would have to pay gain or loss likely on that boot. Now, shareholders don't recognize gain or loss if they receive only stock in the transaction and no other property or cash. So boot a lot of times will be cash, but we see in examples where boot could be, it's that weird other asset. So if I'm giving a truck for someone for another truck, that's truck for a truck. Thinking like-kind exchanges as well, back to that lesson. If someone gives me a piece of furniture as kind of a kicker to make me want to exchange trucks with them, that furniture will be boot. But yeah, a lot of times it will be cash. Does not count if services are exchanged for stock. Let's talk about services. Now, this is something we see in all types of corporations, S-corps, and partnerships, where and it's very common. It makes sense because let's say you have a particular set of skills. Love that movie Taken, great quotable movie. And whether those skills are accounting or painting or anything in between, cleaning, photography, you could perform services on behalf of the company, and that's a contribution. However, that does not count towards the 80% control test. So let's say we have one person who is contributing cash and getting 70% of control of the corporation, and then someone who's doing accounting for the company and they get 10% shares. So that does meet 80%. But the individual who's performing services to get that 10%, that person is not counted towards the 80% control test because services don't count. And the value of the stock received for services rendered is typically treated as taxable income for the service provider. So yeah, you're doing services. It might make sense to do so because you're just good at something. I'm sure we're all good here at a lot of things, but particularly the CPA exam, right? And if you're not good at it, then it takes practice. But that is going to result in a taxable event for you as the shareholder. Diving in here, here's just some miscellaneous items applicable to corporate taxation. C Corps have to file their taxes by April 15th, same as individuals, and any payments are due on this date as well. Late payments or underpayments of $500 or more can result in penalties. It's pretty much spot on, other than the $500, pretty much spot on with individuals. The accounting method, and these could easily be a bunch of multiple choice questions. The selection of an accounting method for tax purposes, whether that's normally it's either going to be cash or accrual. There are other weird methods, but really just going to be cash or accrual method of accounting. You're going to do that by making a selection on the initial tax return. So if you prepare the initial tax return under the accrual method, you now are using the accrual method for your corporation. And if it's cash basis, that's what you're going to do. Donated property. If a corporation receives a donation of property, the basis is considered to be 0. Now, why would anyone donate property to a corporation? I don't know. I'm not here to talk about that. But if why would I just give a donation to Apple or Microsoft? Yeah, I'm not going to do that, right? No one's going to do that. Yeah, I mean, there are real rational instances of why you would do this in the real world, but that's not what we're getting into today. We just want to know that. Quarterly payments. C corporations are required to make quarterly payments, so you don't have to you can't just wait till your April 15th. You pay every quarter. Small corporations, and it'll tell you, it'll give you an idea. It's $1 million or more in income, but generally it might say, the question will say it's a small corporation or a large corporation. They're not going to try to trick you and say 1.2 million. They'll probably say either they make $50,000 a year or they make 200 million. Generally, they're not going to try to absolutely make you lose your mind here. Small corporations avoid underpayment penalties by paying the lesser of 100% of the current year's tax or 100% of the previous year's tax. Large corporations, if you make $1 million or more in income, you have to pay 100% of the current year's tax. So you better get it right. That's why tax planning for corporations, there's whole departments out there outsourced to public accounting firms. Lots of great stuff. Lastly, the tax rate. Now, this was changed with the Tax Cuts and Jobs Act. It may change in the future, and if as such, we will update it. The taxable income for C corporations has a flat 21% tax rate. This is different than individuals who have a marginal tax bracket. This is just simply, hey, you owe $100,000 in taxes, or your taxable income, let's say, is $100,000. Multiply that by 21%, there's your tax. Let's see an example for quarterly payments dealing with a small corporation than a large one. So suppose ABC, we have a small corporation with the following tax liability. We've got current year tax liability of $40,000, previous year tax liability of $36,000. In order to avoid underpayment penalties, ABC Corp can pay the lesser of 100% of the current year tax or of the previous year tax, well, which is going to be lesser here. That's $36,000. $36,000 divided by 4 quarters. This small corporation has to pay $9,000 per quarter in order to avoid underpayment penalties. Now we see a large corporation. We get XYZ Corp, large corporation with $1 million or more in income. They have the current year tax liability of $250,000. I mean, yeah, they also likely have a previous year tax liability, but that's not important because, well, the rule is large corporations must pay 100% of the current year's tax liability. So if you want to make sure you don't have any penalties, maybe you overpay. I'm not here to give anyone tax advice in their corporations, but that sounds like it might be a good option if you want to avoid penalties. In which case, you're going to say $250,000 is the current year tax liability divided by 4 quarters. We are going to have to make quarterly payments of $62,500 in order to avoid underpayment penalties. Looking very good. Couple more points about C Corps. We've got that they do not qualify for QBI, qualified business income. This is something we dealt with primarily in so far up until this point in our individual income tax lessons. This refers to net income generated by a qualified trade or business, which has preferential treatment, which is eligible for the QBI deduction for pass-through entities like sole proprietorships, partnerships, S-corps, and LLCs. Some income types, such as interest, dividends, a lot of passive income, they don't qualify as QBI. So just something to know is that we did see QBI back in the individual income tax lessons. However, for corporations, no QBI here. And also, I mean, this might be not a shocker if you're familiar with C Corps and you're familiar with other entities, but there is no pass-through income here. Pass-through income, then, on the contrary, we have double taxation. Pass-through income is going to be the earnings generated by a pass-through entity, such as all these up here, meaning that income, deductions, and credits flow through to the owner's individual returns, also known as separately stated items. Talk about that when we get to our flow-through entities, but that is going to be something incredibly important to know. If an entity has no pass-through income, it means that there is no income to be reported by the owners on their tax returns. Very good. Some more points, as mentioned, right? Double taxation. We talked about this. Just make sure you're familiar with that. But by the end of this, for sure, you'll know. Limited liability. We talked about this as well, where owners are only liable for the company's debts and obligations to the extent of the investment in the company. So if you are just, you have 2 shares of Apple, and Apple commits horrendous atrocities and they owe a lot of fines and penalties and fees, yeah, you're not going to be on the hook for that. No worries there. Now, while most taxpayers use the cash basis method, and let's pause there for a second. What do we mean by that? Well, generally, individuals are going to use the cash basis method. Small businesses will use the cash basis method. There's really no reason to use the accrual basis method unless you're forced to, unless you have to because you're a public company, because a bank wants accrual basis financial statements, for any reason. That's just simply put, cash basis. It's easier to prepare. It makes more sense for our simplistic minds to consider. Whereas the accrual basis method, if that's required, you'll have to do it. And let's talk about when it's required for certain entities under specific circumstances. And just as another general rule, right? We're dealing with the tax cash basis. This is the exam we're doing. If we were dealing with the financial exam, if we're dealing with audit, that is going to be all GAAP, FASB, all that good stuff. So first off, we've got the first circumstance, such as purchase and sales of inventory. Now, any businesses that maintain inventory and have average annual gross receipts exceeding $27 million for the 3-year period ending with the prior tax year have to use the accrual basis method for tax purposes. It's just, hey, more rules, right? The rule applies because the accrual basis provides a more accurate reflection of income and expenses related to inventory management. More rules to know. And then over here, tax shelters, anything that is a tax shelter, these are entities or investment strategies designed to minimize taxable income. That's not good. The IRS doesn't like that. They are required to use the accrual basis of accounting to prevent manipulation of taxable income through the timing of income recognition and expense deductions. Lastly, we've got C corporations, trusts with unrelated trade or business income, and partnerships having a C corporation as a partner. Any of these entities must use the accrual basis method if they have that same sort of situation. If they have average annual gross receipts exceeding $27 million for a 3-year period. This is just a rule made up by the IRS, and it's basically to target larger groups, larger entities, as compared to small businesses, which the last thing they need is an extra set of regulations to follow. Again, it's here to give an accurate representation of financial activities and prevent potential manipulation. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.Examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.